Jonathan, well, this is different.
Hello, good morning, Eamon. It's different but the same. It's a repeat of something that was offered and brought to a close in about 2008 when the property market crashed, as you might remember. I'm sure you do. So it's actually not a new product. It's just something that's being rolled out once again. It was making up less than 0.5% of all mortgages lent in recent years. After 2008, we saw then 125% loans to value. 100% was very common, and it has now been brought back, I think, to try and solve the problem of the housing market.
But it was ruled out with good reason, wasn't it, after the 2008 credit crunch, because people were overextending themselves. Is that not still a risk now, especially as for the first time in many years we've started to see a few vulnerabilities appearing within certain banking sectors?
Absolutely, a few vulnerabilities there, and of course within the housing market. So there is, you're right, Isabel, a great danger in lending these out willy-nilly. I think if they're targeted very carefully to people who can show a very good credit history and have some special circumstances, then it's not a bad thing. People, all want to own their own homes, and if they've been paying a mortgage that's, a rent that's equivalent to a mortgage, then why not? But my concern would be if somebody hasn't been able to save up even just a few £1,000s over a number of years, what would happen if they do buy a property with a 100% mortgage? They're calling them no deposit or deposit-free loans. They're actually 100% mortgages. I think they've sort of rebranded it. What will happen if they have an unexpected bill or a change in circumstances where perhaps one of the couple, if it's a couple, can't work or loses their job or something like that? What will happen then? And of course, with rental, there's a lot more support from the government compared to owning a property. So if you lose work, it's possible to get housing benefit, and that's much more difficult with an ownership.
Jonathan, what do you expect the uptake to be for Skipton? Will this be good business for them? And listening to you, I'm thinking, well, this isn't necessarily age-related, for instance. It's not particularly for young people. It's not particularly for people at the end of their work careers or whatever. Who will be the beneficiaries?
I think really the beneficiary will be Skipton. They're getting a lot of publicity from this, and they'll no doubt take a lot of inquiries. And it will be then up to them to pick the very best of those inquiries and lend, I suspect, a relatively small amount of money to a relatively small number of people. But it's a case really where people are stuck in properties. Rents have gone up so much. I mean, in London, 20% increases in a year aren't uncommon. And so it's not surprising, really. There are many people paying thousands and thousands a month in rent. But of course, that affects their ability to be able to save. So this is why I think this product has been rolled out.
I was going to refer to the fact that 700,000 households across the UK missed out on rent or mortgage repayments last month, and it's the first time the figure's been so high, and that's got to be worrying in the context of what we're talking about.
It is, absolutely. I mean, it illustrates exactly what's going on, and is this really the time to be lending 100% again after what we may have learned in 2008? I'm sure Skipton will come up with a lot of good reasons why it makes perfect sense, but there is a risk to it. And I think that the 700,000 people having trouble already is probably just the tip of the iceberg. It's going to only get worse.
Jonathan Rolande, thank you very much indeed for your analysis. Jonathan's a property expert.